Hi, this is Ken Boyd with the Accounting Accidentally website and the Accounting Ed Academy, and I wanted to talk about something related to valuations, normalizing adjustments to the financial statements. So the situation here is that, let's say a CEO who's owned a company for 2 decades, a manufacturing company, is considering a sale, and a potential buyer wants to place a value on the business. What the potential buyer wants is to do an apples-to-apples comparison of the CEO's company with comparable businesses. That may require, in a what-if or pro forma analysis, that may require the potential buyer to remove certain transactions from the financials, which is what we call normalizing adjustments. We want to make the financial statements comparable. So, for example, discretionary expenses. The CEO founded the company, he's run it for 20 years. Maybe there are personal type expenses he's running through the business that really shouldn't be there. A valuation person would remove those. Is the CEO's salary comparable to somebody who was a CEO who did not have ownership, who was an independent third party? The salary would be adjusted in the valuation analysis. Operating versus non-operating income. Is most of the business's profit based on the day-to-day operations, what they do every week to make a product and sell it and collect money from customers? If so, that has value. However, if the company is only making a profit or primarily making a profit by non-operating expenses, that's not sustainable. You can't have sustainable sales and earnings if you're, for example, selling assets to make a profit rather than your day-to-day business. So that's a consideration to a valuation person. The other thing I wanted to mention was related party transactions and also accounting principles that the company uses in their financials. So if you're an auditor or you're familiar with auditing, related party transactions assumes that anything that is not done with an independent third party who has no other financial interest is a related party transaction. The flip side of that is we assume that all transactions are arm's length, where the buyer and the seller have no other interest other than coming to an agreement. If there's something other than that, it's a related party transaction. So for example, CEO buys supplies from his brother's company at a unique price that a third-party supplier wouldn't charge him. It would be higher. The board of directors supplies raw materials to the business under a special agreement. So a valuation expert wants to assume that all transactions are arm's length, not related party. That may require an adjustment in their analysis. Finally, accounting principles. A, are accounting principles used, generally accepted accounting principles, and B, are they applied consistently? Because even if accounting principles applied, if it's not consistent, that is, if it's changed, it's going to distort the financial statements. So for example, if the company changes from FIFO, F-I-F-O method of inventory valuation to LIFO, L-I-F-O, that's going to change the net income and the cost of sales from one year to another. It's going to distort the financials, which is why when financial statements are audited, we always have that comparison explained so the financial statement reader can see the impact. So if a potential buyer sees a change in accounting principle, they're going to look at that type of disclosure so they can do an apples-to-apples comparison. So all this is about a potential buyer placing a valuation on a company. Remember that accountingaccidentally.com is where I have my blogs, links to all of my YouTube videos, nearly all of them here, and also accountinged.com, dozens and dozens of hours of training videos on an online academy, subscription-based academy where we keep adding video content all the time on accounting. Thanks very much for watching, and we'll see you next time.